So let's go and let's use Apple as an example, and let's talk about the butterfly strategy. Okay? It's three different butterfly strategies that you want to be aware of. Okay, you have a traditional butterfly, that's number one. You have a non-traditional type of butterfly strategy, which is called a broken wing butterfly. And then you also have what is called an iron fly or an iron butterfly strategy, which is kind of a sister or brother of the iron condor. So that's why those names sound similar, because you're playing calls and puts with the iron butterfly, just like you are playing calls and puts with the iron condor. Okay? When you are setting up an iron a butterfly strategy, a traditional one, it's you're usually going to be at or near the at the money level, and the probabilities are usually small, right? They're usually low. Um, your ability to win on the trade. If you're the seller, if you're the buyer, if you're the seller, the probability might be a little higher. If you're the seller, it might be a little less, or a lot less. But it's a reason you can do the traditional butterfly. I just don't like them. I'm more of a fan of the broken wing butterfly and the iron fly. But let's break down the traditional really quickly. A traditional butterfly, if you are the seller, looks similar to something like this, right? So if I went and I did a 10-point wide butterfly here, right? This is the selling of a butterfly. So when you're doing a butterfly, the middle of the position is considered the body, and that's where you're putting two contracts. Okay, so we have two here, and one here, right? And so this is a wing. Kind of try to picture the butterfly. Okay, this is a wing. This is the body of the butterfly, and then this right here is a wing as well, right? So you got the two wings and the body. A traditional butterfly has the same width between all three of the strikes or the legs. So right here we have 10, that's 10 points difference, right? And then right here we have 10. So that's all the same. But traditional, all the widths of the legs are the same. So it's not broken. Okay, it's not broken. Um, and so in this example, we are selling this one, and you can see that the probability of winning on this is 66%, what TastyWorks is saying, right? That's obviously a lot better than just a coin flipping probability of 50-50. And the most you can make on this is 167. It's not bad. And the most you can lose is 833. So if you wanted to say return on your capital is, that's more than 12%. So that works for the Dorian Way, right? But the risk with this is that if it falls right here, right? If the price pins right here, which is the probabilities of that are almost zero, this is where you will have your max loss at 130. Okay, 130. You have your max gain if it goes up, and this is going up in the direction um, of the option chain. Going down on your screen is actually going up on an option chain. So this is the kind of function of a butterfly. I want you to understand that a butterfly is two trades that's fused into one. Okay, two trades that's fused into one. So what I mean by that is that this is how the butterfly looks. Okay, it looks very similar to this. Okay, so you can see with these, this you have a bull. In this example, you have a bull put spread, and then you have a bear put spread. Okay? You have a bull and a bear put spread, and then they're kind of fused together right here to make that body. And this is where you have two contracts, and then the wing is here with one contract, and this wing is one contract. Okay, so the middle is usually double the contracts of the wings. Right? So if you wanted to do two contracts, you have four in the body and two at the wings. Okay? So And so when we change this back, this is how the butterfly looks. You have, this is the traditional butterfly, right? It looks just like that. And then if you go to a curve view, you'll see the TastyWorks curve view has been acting up a little bit, but this is how it works, right? So this is the at the money line. If it goes up, you're going to win. Um, you know, a 100% of the time. It can actually go down um, quite a bit. If it goes down quite a bit, you can win on this trade. But if it stays within this range here, which you have a 60% chance, 66% chance you're going to win. If he stays in this range, then this is where you lose at, right? This is your loss zone. All right, so that is the traditional butterfly. A broken wing butterfly is very similar to this, and I'm not going to tell you how we like to set up the broken wing butterfly at the Dorian Way during this call here. But a broken wing butterfly is just basically when you literally one of the wings are not going to add up. They're not going to have the same width of the spread. So in this case right now, let's say we did this. Well, this right here is 10 points wide, as we talked about, and then this one here is 30 points wide. So it's not traditional, it's not all the same. So it's a broken wing. This is the broken wing here. Okay? This is still the body, this is the one wing, and then this is another wing. And so the broken wing butterfly could have you can set it up to be a very high probability trade. You can set it up to be a lower probability trade. In this case, you have a 63% chance of winning on this trade, and you have the potential to make as much as 2,000, and you can lose as much as 931, as you can see here. But a broken wing butterfly is just simply, once again, all the legs of the spread are not the same. Okay, they're not the same. And so a broken wing butterfly can be structured a number of different ways. For time purposes, I'm just going to just indicate it that way to you at this point. That's how a broken wing kind of is structured. Now, an iron fly or an iron butterfly, as I indicated earlier, is like a sister or brother to the iron condor because you're playing both sides. When you're doing a traditional butterfly or a broken wing butterfly, you're playing all calls or all puts. And the examples I just gave are all puts. But when you're doing an iron fly, or an iron butterfly, you're playing both sides just like an iron condor. So an iron butterfly starts with selling the at the money straddle. Okay? Selling at, you can obviously buy this too, but at the Dorian Way, we're primarily option sellers. So I'm showing you the selling of these butterflies at this point. An iron butterfly means that you're going to sell the body, right? This is the body of the butterfly, and then you're going to buy the wings. And normally you're going to buy a wing based on the expected move. So in this case, the expected move is about 11 plus or minus 1130. So you can do it a little wider, you can do it a little less. So in this case, we're going to buy this here on the call side. That's 10 points wide from the body here. That's 145, and then we're going to, from 10 points lower, we're going to buy this 135. So now you can see this is how this is structured. Right? We need it to stay based on the premium that we received. For us to win, we need it to stay within $7.55. Okay? We can make as much as $7.55, but the odds on that are darn near zero, because it would have to pin here at the 145 for you to make that $7.55. So the odds on that are not very high. If they're almost zero. So you don't bet on that. And you can see that this is a low probability trade, right? These iron flies are low probability trades, but you can structure them in such a way that you're going to get a big profit, get a big premium, and your max loss can be smaller, a lot smaller. So in this case, 245, and that's how much you have to put up. So when we're trading iron butterflies or iron flies, we want to get out of these type of trades once we're up 25-30%. You don't want to wait to expiration, because your probability is going to be very, very poor. Okay? All probabilities are based on expiration. At the time of expiration, you don't want to wait to that long, because you're going to lose the super majority of time on these iron flies. But if you if you take this opportunity and get out at 25%, we usually believe that that's going to take you up to 50 or more percent, up to 60% on these iron flies, your chance of winning. So you want to keep that in mind. So if we go here to the curve view and kind of look at this iron fly, you can see that it's set up similar to an iron condor. An iron condor, you can lose if it goes down too much. You can lose if it goes up too much. So this iron butterfly, this iron fly, you want it to stay within a range, and that's how you can win. That's your win zone. Okay? So those are the three different butterfly strategies that I wanted to kind of have a teaching class on this afternoon. If you have any questions, please unmute your mic and present the question.